By now, everyone will have pored over and dissected the latest shareholder letter from Warren Buffett.
Warren Buffett released his annual...
And I mean, for good reason.
5 decades of success.
Very successful.
Stock market has been booming along.
Well, I thought he was a prodigy.
And while I've been reading this year's letter and just reflecting back on one of the best performances in investing history, I couldn't help but feel there are some great lessons for any investor in this year's edition. And I just haven't really seen many people covering them in this way. So I thought I would. I hope that's okay with you. Anyway, Warren, drop a beat.
1 million, 2 million, 3.
Because you look so fine that I really want to make you mine.
Page 1 of this letter has to be one of the hardest flexes in finance. Just a couple of columns of data showing Berkshire Hathaway's average return versus that of the S&P 500. And it's safe to say at this point that Berkshire have dominated. 60 years of outperformance at these levels is just ridiculous. But we know this, we know they're good. But I think within the data, there's some really important takeaways for us as mere mortals just looking to put our money to work. So to demonstrate what I want to discuss, I've just simply taken the data for the last 60 years and then plotted it on a graph. In blue, we have Berkshire's results, and in red, we have the S&P 500. As we sit here today and say that Warren beat the market, we can do that with the certainty of hindsight. I mean, wouldn't you just love to go back to 1965 and give the man $1,000 to invest for you? But this chart serves to highlight just how bumpy that ride has been for investors. I just think it's a really important lesson, especially in the current market conditions around volatility, and how the average rate of return many quote is not the rate of return you will see year to year. To show you what I mean, this red line is the 10% average return of the S&P 500 over that period, and the blue line is the 20% that Berkshire have delivered. Notice how in both cases, neither of them really have delivered those returns in any year. It's more often than not significantly above or below that. So in order to benefit from this long-term return that's made Warren a multi-billionaire, you would have had to have stomached some eye-watering drops in the value of your portfolio along the way. Like in 1974, where the value of your portfolio would have halved, while the S&P 500 only dropped by 25%. How many people do we think would have lost faith and sold out and then would have missed out on this ridiculous 124% return in '76? These results are a lesson in patience and long-term thinking, and most importantly, the volatility all investors must learn to stomach in the pursuit of long-term average returns.
In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get.
Not even Warren and Charlie could smooth this journey out, and they're arguably the best to have ever done it. Before we continue, let me just tell you quickly about today's video sponsor, The Daily Upside. They actually covered this story about 10 days ago when it first broke. Not sure what took me so long.
I mean, what do you think? I think it looks great.
This is the best thing about The Daily Upside. Not only is it completely free business newsletter sent to your email inbox each day, but because it's daily, you get reaction and commentary on exactly what's happening that day without all of this sensationalism you'll get from traditional media. It's well written by actual finance professionals, and in 5 minutes you get a full overview of all the major stories of that day. Like I said, it's completely free to sign up, and all you have to do is click the link in the description or the one in the pinned comments below for you. You just type in your email, press go, and that's it. And if you don't like it, you can always unsubscribe. But, I'm going to bet that you will like it. In fact, speaking of bets, these guys have hit some huge home runs in the last 60 years, especially in the early days over here. Triple-digit returns in a single year. It was actually really much easier for them to do this in the past when they were a smaller company. You can see that the performance of Berkshire Hathaway and the S&P 500 track each other more closely in recent years. And this is because Berkshire holds such large positions in companies within the S&P 500, they're actually in the S&P 500 themselves as well, that their performance is inherently similar. Also, let's be real here, doubling a couple of $100 million is a lot easier than doubling a couple of $100 billion. I mean, this is coming from a guy who struggles to double a quid. But that shouldn't take away from the achievements. Triple-digit returns on any investment. Outrageous. Warren actually discusses these successes, but true to form, discusses it from the perspective of his mistakes. I'm collating a few quotes here into one section just to give you an idea of the tone throughout this letter. Over the years, I've made many mistakes. At this point, I think a report card for me is appropriate. In 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. He's saying that a lot of his investment decisions have really just been average, in some cases bad. Our satisfactory results have been the product of about a dozen truly good decisions. That'd be one about every 5 years. The best investor on the planet's success which he calls satisfactory. I mean, what a guy, 100 billion net worth, yeah, it's all right. He says anyway, that all comes down to just a few good calls that went very well. The weeds wither away in significance as the flowers bloom. Warren is saying here that a few good investments have made up for the not so good ones. Now, before you think that's free license just to invest in anything you want because one home run will make up for the rest of the bad mistakes, if the world's best is saying that his decisions were bad and just a handful of good ones produced the majority of his returns, we really need to question how confident we are in our own ability to identify the flowers and then just to hold on to them. Just to highlight what a task that is, I want to bring some data to your attention. So you're probably familiar with the Pareto principle. This idea that 20% of our actions drive 80% of our returns. Well, this applies in the investing world, but it's more like 5% just does absolutely everything. A recent research paper by Hendrik Bessenbinder of W.P. Carey School of Business suggested that almost all of the outperformance of the US stock market versus bonds could be put down to less than 5% of the companies. So if you take the S&P 500, which is around 503 companies, 25 of them would be responsible for all of the gains in any given year. The rest either did nothing or took away from the gain. So the average 10% is really a few companies doing really well and a load of others just doing badly. So if Warren's point here is that a few good investments have compensated for the bad decisions over the years, if we apply this to normal investors, then I think the takeaway is there are very few flowers and there are hundreds of weeds. So if as an investor you say, I won't buy the index fund and its average rate of return of 10% a year, which is excellent, I instead think that I can do better than that. What you're actually saying is, I'm confident that I can identify the 25 or so businesses out of this list of 500 odd that will deliver the market-beating returns. This is why 90% of fund managers fail to beat the index long term, as doing that year in, year out consistently is hard. I think sometimes due to Warren's talent of making what he does sound simple, people start to think that it is simple. It isn't. Warren and Berkshire Hathaway's success is built on the fact that they have an incredible ability to value businesses and to identify when great businesses are being sold at great prices. They also have this temperament and mental fortitude to ignore the wider market and often move against it when all others are losing their heads. It's this rare combination of skill and emotional intelligence that not many possess that has seen Warren and Berkshire Hathaway be so successful. Warren describes their success as a bumpy road involving a combination of continuous savings by our owners, the power of compounding, and our avoidance of major mistakes. He doesn't mention his clear and obvious talent for valuing businesses, but I guess the numbers do the talking. But I still like this because I think with these points of success, we can apply these to almost any investor's journey, especially if you're like me and you invested mostly in passive index funds. A continuous investment every month long term to benefit from the compounding that produces and the acceptance that the ride will be bumpy, but that's just all part of the process. This avoiding mistakes part is very interesting and speaks directly to me and how much of my portfolio I'm willing to risk on more speculative bets, like crypto or individual holdings. It's this realization that a cautious investor who avoids big mistakes can have a very good outcome, but a risky investor who rolls the dice, chasing moonshots, could end up with a lot less than they started with. Next time you're tempted to roll the dice on the next big thing, try to remember how important it is to limit big mistakes and let that guide how much money you throw at it. Now, we could just end the video here because really for most investors, those core principles are enough. But there's another section of this letter that I want to discuss as it's something that's been playing on my mind. And I think it's an interesting conversation that we need to have. So when Warren was discussing the reasons for Berkshire Hathaway's success, I missed something off. And most important of all, the American tailwind. Warren first coined the term American tailwind in his letter from 2018. And really, it could be summed up as his belief that over a long enough time period, America will always grow, continue to innovate, and ultimately thrive. I've yet to see a time when it made sense to make a long-term bet against America. Over his lifetime, he's always been right, but not everyone shares his view that America will always be king. Ray Dalio, founder of the largest hedge fund on the planet, and is someone that I enjoy listening to. Now, he is not as upbeat about America and its chances as Warren. I mean, the title of his latest book kind of says it all. The Changing World Order, Why Nations Succeed and Fail. Maybe it's a rom-com. No, but seriously, we could talk at length about this topic. I mean, Ray literally wrote a book on it. But I'll frame it like this for you. Once upon a time ago, the Han Dynasty, the Ottomans, the Mongols, the Romans, and everybody's favourite, the British, were all global leaders. All of that influence has ultimately faded over time. The The Americans are top of the pile right now, at the moment, but Ray would argue that that position is not guaranteed, and in fact that all superpowers will eventually be replaced. Now, it is very true that a bet against America up to now has been a bad one. This table shows the returns over the last 10 years for the S&P 500 and the FTSE All-World excluding America. So basically, America versus the rest of the world. The difference in returns, as you can see, is significant. But it's a big old world that we live in. Maybe it's because I live outside of America, but I do like to think that other markets have potential. Come on, UK, you can do it.
Look, I'm a proud Brit, but let's face facts. Sorry, no, there's no other word for it. It's just
Who knows what will happen and what the world will look like in 10 years. For me as an investor, I'm just looking to capture the return on offer from the market in general, because that's sufficient for me to build long-term wealth. So I buy a global index in the main as a reflection of this, and then I have a little bit of fun money on the side where, I attempt to buy some flowers.
Crap weed.
Now, while I would love the average return of 20% a year that Warren has got, we need to remember that this guy is the GOAT. We sit here studying him because he has done something remarkable. It's like watching Messi play football and then expecting to recreate that level of playing on a five-a-side pitch on a Friday night. Warren's skill as an investor is pretty much unrivaled, his track record unmatched. He has made countless investors who backed him wealthy, but his best quality is his openness and willingness to communicate to the investing world the basics he thinks anyone can follow to see some success. Through his letters, we're able to stand on the shoulders of a giant. That's why these letters are so important, and why the teachings within them will outlive Warren and probably outlive most of the people watching this video. It'll be a sad day when Warren doesn't write any more of these, so you just need to enjoy them while you can. Below is a link to all of the letters going back to 1975, and I've included like a top 5 list as well of some of the classics, if you want to just dip in and out. But for now, one last time, Warren, take it away, my man.
You got to
Take my hand and come with me because you look so fine that I really want to make you mine. I say you look so fine that I really want to make you mine.